Bridget Brick joins me, and you can learn what her team is up to by heading over to getbrickcapital.com. That's going to be a clickable link in the show notes.
Thank you.
So, we're going to be talking about funding of those real estate investing projects that everybody has going on. Bridget, I'd be curious. Let's start things off with how you found your way into this, because I know you have kind of a tech background as well.
Yeah. So interestingly, I worked with a company doing loans while I was at university. Shortly after graduation, I was magnetized over to the tech world, we could say, with the glitz and the glamour and the expected huge payout that you can get when you're with a startup in the very beginning. It took about 10 years of me realizing, I'm good at this. I like it. I ended up doing a project for the New Zealand Trade and Enterprise Office where I authored a playbook, which then I used for my consulting agency. And that led me into 2020, where I really had a spiritual awakening. And I realized while I was good at what I was doing in the tech world, I didn't really like it. I was only helping a few people and I was really only helping them for their cause. I really didn't feel like I had an effect on people, overall everyday American. And so I left my heart open to anything that would come my way. And I ended up doing a project for a different brokerage. And as I learned how these specific loans worked in the industry, they're called DSCR loans. I ended up meeting a client who had a huge real estate group. And it turns out they needed a different loan product than the brokerage I was with. So I went out into the market and found a specific loan product for that type of investor. And that is the basis for which I opened my own. So we now have a huge hedge fund, hundreds of millions of dollars behind it, really giving out these loans. And so we're a table funder in that regard and can help you get DSCR loans that look at income of the property, not income of the individual.
Yeah, that's especially important, especially when people are getting into this real estate investing game.
So, yeah, you'll find in the industry those who have a hedge fund behind them, such as a table funder. And that's really what we use is we are direct to source of the hedge fund and we're able to get you funded. And these are 30-year fixed loans. This is not a private money loan or anything like that. So it's a very attractive loan for real estate investors.
Well, let's say somebody is interested in something like this. What type of information do they need to have in hand before they engage with a team like yours?
Sure. So if you are purchasing a property, you really only need three things to qualify. One is a credit score of 660 plus. The second thing is a minimum down payment on smaller properties of 20%. Once you get into commercial, you're going to need 25% down. Plus, you'll need to show between 6 and 9 months reserves. Now, those reserves are not escrowed, they just need to be shown in an investment or retirement account. And the last thing is on the income qualification portion of the loan. We don't look at your income. We look at the income that the property produces and we underwrite that. So it's really only those three things that you need to qualify. Now, once you find a property, that's when you come to us. So first you want to go out into the market and find a property that you think you're interested in. Then we have an intake form on our site. You just enter the deal summary. You're not entering your social or your credit information at this point. We're not pulling credit. We just need an idea of the numbers. So we're going to take that to our hedge fund and say, is this something that can be underwritten? Does this look good? And if they say yes, then we move forward with a formal application. Now, if you have a refinance, that means you already own properties and you want to cash out. Then what we're going to need is same thing, the credit score of 660 plus. We only need to see reserves in this case, so we don't need the down payment because you already own it. And the last thing is the lease information. The lease amount needs to cover the cost of the loan. So you need to be at what we call a DSCR of 1.0.
So, in the refinance piece of it, did you require any kind of level of seasoning?
Where no seasoning is required. What I was working with was an investor who would find properties for, say, between $80,000 and $100,000. And yes, there are markets where you can still buy single families for that. His group would then remodel them into duplexes. Once they're remodeled, they would be worth 325, sometimes 340. So we would do now they put about 100 grand into it. So they're into it for 180. They'd be worth maybe 300, 325. So at worst case scenario, 300, they're able to take a cash out of 75%. So that's $225,000. So the 225 pays off the 180 and leaves them with 45,000 minus closing costs. in their pocket to go do the next project. And so with them, as quickly as they could turn the properties over, they could then refinance. So there's no seasoning required, but you will get better rates if you do have at least 90-day seasoning and if you have a lease upon close.
So I was going to ask you about the interest rates. What can somebody expect regarding that?
The interest rates are not tied to your experience. They're tied to the treasury rate if you're on what we call our standard program. And so every day that treasury rate, that treasury bond changes a little bit. So if you get a quote from me today and then we get you into underwriting 2 weeks later, which is when we get the appraisal back and all the title docs, the rate may have gone up or down slightly depending on what the treasury is doing that day. So when we lock you, that's your rate for the day. But these rates are usually about 1% higher than conventional rates. So it's not that much of a difference. And the type of person that really needs our loans, these loans are a fit for the type of person who is an entrepreneur who has a lot of tax write-offs. So you don't look like you have a lot of income, but you have a lot of income that you want to maybe invest. The second thing is it's for a person who does not want these loans to show up on their credit report. So when you close these in an LLC, this is considered a business purpose loan, which is also why the rates are about 1% higher than conventional. It's a business purpose loan backed by real estate, but they don't show up on your credit report because it's your LLC who's taking the loan. Now, you will sign a personal guarantee, but again, the loan is in the name of your LLC. So that's a huge advantage because a lot of real estate investors want to be able to scale. And once you sort of hit your max with conventional loans, you're not able to get another conventional loan. You sort of max out. We are the bridge between that. DSCR loans allow you to take another 30-year fix without having to pay cash for a property.
Sure.
Mhm.
So, I think what we probably want to do is take a moment and kind of explain this DSCR,
CR. Uh-huh.
yeah, DSCR versus what a hard money lender is, because I think
Yeah.
a lot of people, I get a lot of hard money lenders on here, and frankly,
Mhm.
what you're offering is quite a bit different. So
Yeah.
I just want to make sure we define the difference here.
Yeah. So a hard money loan is a short-term loan, a bridge loan, a renovation loan. It's all the same thing, right? So whether you hear those words, they're interchangeable. It is a loan that is meant to not last very long. It's a short-term loan. So, I've seen them have terms of 12, 18, and up to 24 months. Normally, I think that's what people default to when they max out conventional loans and they wanna buy another property, but they don't really have a choice, so they'll go get, like, this bridge loan. It's very expensive. Those rates are 10 to 13%. So it's not that we don't offer them. But again, those are meant for you to get into a property quickly. You need the money quickly, right, to get the property. And then usually there's some sort of renovation involved. Once you finish the renovation, you want to get out of a hard money loan. You don't want to keep a hard money loan because, again, it's so expensive to hold that over time. So we would be who you come to refinance out of the hard money loan into a DSCR loan because again, DSCR loans are 30-year fixed. So we have a 30-year fixed option or a 10-year interest only. And really, you want to think of a DSCR loan like a conventional loan, except it's not underwritten based on the individual, it's underwritten based on the income of the property. So I would compare DSCR loans closer to conventional loans than I would hard money loans. They're not even near hard money loans.
No, and you're kind of like somebody would take a hard money loan, acquire the property quickly, and then possibly within ideally 90 days later would go into a loans with your company.
Go into a DSCR loan. So say you find a property like my client, we can lend a max of purchase price plus renovation, not more than a purchase price. So in that example, if you find a property for 80,000, we could give you 80,000 for the purchase and up to 80,000 for the renovation. Now, if you qualify with net worth and liquidity, we could finance all of that. So we can finance the full 160 where you're not really having to come out of pocket for anything except closing costs. So that's a very attractive product that we have. You would take that if your intention is to add value and then cash out the value after. The number you want to be careful with when you're getting that renovation loan, that first half, is you don't want to spend more than 75% of the after renovation value. So if your after renovation value is 300, multiply that by 0.75, you'll get 225. On your purchase plus renovation, you can't spend more than 112,500. right? So 112,500 for the purchase, 112,500 for the renovation, you'd be breaking even. So even that's not a great scenario. You really want to be less than that so you can have money out of pocket when you finish. So say you do your renovation and you're finished and you're wrapping up, you have two choices of exit. You can sell it or you can refinance it. So a lot of people sell it. That's fix and flip. You see these shows on HGTV. Oh, we fix it. We sold it for this much profit. Depending on what kind of tax strategy you have in place, you may have to pay taxes on that profit. Or if you do a 1031 exchange, otherwise you have to whatever you end up in profit, you have to take out taxes in your calculation of how much you're left with. So a lot of investors have gotten savvy and said, I'm just going to keep this. I'm going to put a renter in it and I'm going to refinance it. So then going that route, you end up doing a second different loan product. That's the DSCR loan. So first we get you the renovation or the bridge loan, the hard money loan. You do your renovation, you get a renter in there, then we cash it out at 75% of the new value. Now, one thing I want to mention, which is different with how we work is, and this is something I've put in place specifically for these type of investors, your after renovation value determines everything regarding the loan. That plus the market rent income, right? Because the market rent income and your lease has to cover the cost of the loan, the total PITIA. If you end up with an appraisal with a random lender and a random appraiser who doesn't really know the area and has come in from out of town, you may get a terribly low value. And we've had this happen a couple times where the one person gave a value of 118 on a $170,000 property. So the way that we work is, remember, we work with a table funder, so we underwrite the whole file and then we take it to them to give the money at the end of the day. We are able to look at the file and look at that appraisal and say, hey, this doesn't work. We're going to throw it out and order a new appraisal. And we even take it a step further and say, if you or your real estate agents know of a good appraiser who's been in that area a long time and will give a fair value, we'll get them signed up on our AMC panel and we'll send the bid request to them. So they get put on a bid panel where they and other appraisers see that. And so it's a lot easier to get that ARV when you have an appraiser on the panel that's been in the area a long time. And so I would say that that's probably one of the biggest things we offer to our cash out refinance investors is that capability.
Are you focused on any particular areas of the country? Are you nationwide? And
Mhm.
what type of boots on the ground do you have in those areas to make sure that you can do what you just suggested?
Yep. So we are nationwide minus Minnesota, Utah, North Dakota, South Dakota. So we can pretty much do anything. I don't know of a lot of people that invest in those states, or I haven't had a lot of people come to me with requests for those states anyway, except for yourself. But those are the 4 states we can't do, and the reason is you have to have a physical office location in order to be a lender there, and we just don't do enough volume to justify having a physical location in those 4 states. So, otherwise, we can get the loans done for you. When the borrower comes to me, who are your real estate agents and their suggested appraisers? So, it's gonna be your network that you come to me with. There are a couple of cities that we've done over and over again that we kind of know the appraiser panels in those cities. But if it's a different city that we're not accustomed with, then we would ask that you and your real estate agent bring that.
Sure.
Mhm.
Just to remind everybody again, it is getbrickcapital.com, getbrickcapital.com. I'm going to have make sure that's a clickable link in the show notes. If you found some value in what we were talking about so far, do us a quick favor, share this with one of your investor friends. If you're watching us on YouTube, give us a quick like and subscribe. So, Bridget, could you kind of give us a breakdown of the timeline? What type of
Mm,
turnaround should somebody expect? I know that the hard money part, that initial one, is probably quite a bit shorter, but
yeah.
is it 30 days? Is that fair to say?
For a hard money loan, we can close in 10 days. So as long as you get me all of the documents we need, we get your bank statements uploaded. Now, hard money loans do require different documents. They require tax returns and bank statements and things like that. But those can close in 10 days. When you get to the DSCR loan, so DSCR purchase, DSCR refi, our process goes like this. We send you a quote. You say, yes, I want to move forward with these terms. We send a formal application. Once that's complete, our team orders title insurance and appraisal. Once we receive all of that back, plus all the documents we've requested from you, which is really going to be 2 months bank statements, 4 entity documents, your driver's license, your purchase and sale agreement, if it's a purchase, or your HUD, if it's a refi, If you have a property management, we want to see that agreement. If it's a property you own, the lease. So it's not very many documents. Once we receive all those back, plus the third-party documents, title and insurance and appraisal, we will then submit your package to the underwriting team. That's when we pull credit and lock your rate. So notice the timeline there is if we get that appraisal back and you're not happy with it, we have not pulled your credit. We have not done anything. So you can then decide, okay, I want to do another appraisal. Or, you know what, this is not the time to refi. Or, you know what, I'm going to sell, right? So you haven't had your credit pulled while you're waiting on that number. So you get the number back and then we can make a decision about what to do. If everything looks good, we submit it, credit pull, rate lock, and it takes about 2 weeks to underwrite the file. So you'll close in 4 weeks.
Okay.
Mhm.
And then for the 30-year fixed, what type of turnaround is that?
Oh, that's the 30-year fixed.
Okay,
Mhm.
that makes sense. So, with all of that being said, earlier you mentioned that this is still going to be personal guaranteed.
Yeah.
Is there any point where you're working with somebody where the company is large enough where it just becomes a business guarantee?
When you get into a commercial property is when you don't have a commercial guarantee. I mean, a personal guarantee. So DSCR loans are good usually through 8 units. Once you get into 9 units and above, it's looking like a commercial property, which is a little bit of a different underwriting process. It might take more documents. You can still close in 30 days, but in that case, because there's no personal guarantee, then they want a few more documents to be able to underwrite it.
Sure. And do you do any of those loans, or are you
Yes.
pretty much staying with the 8 units and under?
No, we can do up to 100 units.
Oh, okay.
Mhm.
So, one of those things that I noticed regarding some of the information I read about you is that you did a little controversy around why you think everyone should abandon their 401k.
I did. You know, the person who designed the 401k even said it doesn't serve the American people. And, the there are words used like the penalty you have to pay. And if you think about the difference between the word penalty and fee, you feel like you're in trouble if you use the word penalty. So it psychologically prevents you from doing anything in that regard. Oh, I'm going to be in trouble if I do this. So nobody thinks like, oh, I'll cash out my 401k. Now, of course, there is a fee, right? You have to count that in. It also is taxable income. So you will pay taxes on that. So these are things you have to assess. But I want you to ask yourself, do you want to passively give away your opportunity to grow your wealth in your future? Or do you want to be actively involved? Because whether it's 401k or investments or you're getting a loan from the bank, every one of those investments turns around and invests in different things. And one of them is real estate. So you have this middleman in between you and your money and your outcome. And so you've kind of like given it away and said, oh, I hope this turns out like everybody said it's supposed to turn out. So I'm sure I'll be fine. And then you hear these horror stories of people getting to their retirement and their 401k is not worth anything or something, drastically the value of something fell, right? And so that's because there was a passive involvement. You didn't have an active involvement in what was happening for your future. With something like real estate, you have active involvement. So if you take your money and put it somewhere else, like real estate, now you're actively involved in buying something that will gain appreciation over time that someone else is paying for, right? So with a 401k, there's a matching. You can only contribute up to so much percent, and then the employer contributes so much percent, but you're still paying for it. Who knew that you could buy something that somebody else would pay for your retirement? But that's how real estate works. You're buying a piece of property that gains value over time that you can cash out tax free later, and someone else is paying for that retirement. Like your renters are paying your mortgage. Your renters are paying for your retirement. To cash out, say 200,000, maybe you've got 50,000 in fees and taxes. I don't know what the number would be depending on your tax strategy. You've got 150,000 left. Well, if you're able to deploy that across say 5 to 8 properties, now you've got all that appreciation plus someone else is paying for those properties over time and even potentially cash flowing. You may even cash flow 500 to 1,000 a month.
Well, I was hoping you could share a story, like a recent
Mhm.
client or somebody that has gone through this process,
Yeah.
where they started and where they are today.
I have a couple of stories. One of them is there's 2 single mother stories, but one is a single mother who the spouse left, decided that marriage wasn't for him anymore. So she's left with these little kids and she's never worked. So she sort of panicked. And I think she was left with a total of $200,000. And so if you think about it, how far is $200,000 going to last with three little kids? With the cost of living, she might be able to stretch 3 years out of that. Or she can take it and invest it where her investments pay her. So what she did is she found 3 single-family homes in Ohio, in Cleveland, and Cleveland's one of the markets, Cleveland, Philly, a few others, Detroit, where you can purchase these homes for really, really low. She bought them as a bundle. So buying them as a bundle, she was able to buy them much less than if she bought them individually. So we took about, I think it was 85,000, right? So 85 divided by 3, let's call it 27,000 into each property as a down payment. Those properties each cash flow $1,000 for her. So with her $85,000 down payment, she bought herself a salary of $36,000. That's a salary she's going to have every year for the next 30 years. And that will grow over time as rents increase, but her mortgage doesn't increase because she's on a 30-year fixed. Okay. So she said, well, gosh, I'm going to do this with the next 85,000. So she bought 3 more single families as a bundle. She did the copy paste, right? Bought herself another $3,000. So now she has a $6,000 per month salary every month for the next 30 years. And yes, of course, she's going to have to she has the money saved aside for 6 months to 9 months of reserves. And yes, maybe the hot water heater goes out in 2 years, and in 5 years, a roof goes out, right? But at minimum, she's bought herself at least, what is it, $72,000 salary. So she was able to turn her $200,000 into a $72,000 a year annual salary. So now she doesn't need to worry about what she's going to do after 3 years. There is no cliff to fall off. And so that's the power of real estate, is it can take somebody who's in a very desperate situation and it can allow them to buy something that looks like a salary for themselves. There's only a few markets you can do this. And people are going to say, oh, in my city, you can't buy houses for 100,000. Yeah, she doesn't live in Ohio either. So there are ways to do it. There are markets you can get into that still cash flow. And so in her situation, with the power of our loans, she was able to rescue herself, right, from a pretty desperate situation.
Was she able to tap into some of the people that you know to help her with this?
She ended up tapping into our appraisal network. So in her case as a purchase, it didn't matter, but the seller wanted their purchase price. So had the appraisals come in too low, had we not had a good appraiser on the panel, then she would have had to pay the difference out of pocket because we can only lend on the appraisal value or the purchase price, whichever's lower. So if her purchase price was more than the appraisal, she would have had to pay the difference, which would have eaten into her 200,000, right? So I think it's important to have an appraiser who's going to give the right value also compared to the purchase price.
I appreciate you sharing that story because
Mhm.
I think that is the fair idea of the power of real estate. One of the
Mhm.
things that really struck me when you said that too is we're dealing with some crazy inflation and
Yeah.
economy right now where
Mhm.
rental income is impacted by those inflationary rates, and that can be adjusted way quicker than most investments. You can
Yeah.
make those necessary adjustments when you need to.
And that's the thing about being an active investor in your retirement. When you're active, you can make those decisions. When you are passive, all you do is see the stock market fall and there goes your retirement. And how many cycles has that happened? Depending on your age, you will see how many cycles that's happened in your life. And so you'll start to see, okay, maybe I have to pay a fee of $50,000 to cash out my $200,000 401k. But what can I do with the 150 left over? I can buy myself a salary of $72,000 for the next 30 years. And then don't forget at the end of the 30 years when the loans are paid off, you can sell the loans, you can cash out refi the loans, take all of the value, right, that you've gained over the years and live off of that money tax free. You cannot do that with your 401k. You can't grow it to this exponential amount and then just live off of it tax free.
Well, Bridget, this is a fantastic conversation. I really appreciate you giving us so much time. Again, I'm going to point everybody to your website. It is getbrickcapital.com, getbrickcapital.com. That's going to be a clickable link in the show notes. Before we jump into the rapid fire questions, is there any questions or concepts you think we should have tried to cover here?
I think the best time to invest in real estate is yesterday. I think my loans allow a person who's been sitting on the fence or thinking about it an easier path to get into real estate There are ways for you to save down payment or get liquid so you can have the down payment. And once you get on the path, it just continues to snowball. Sure.
First one is, what lie do real estate investors sometimes tell themselves?
So this is an interesting perspective. The asset is not really the property, it's who is willing to pay to live in the property. And that really ties back to, if you water it down, location doesn't matter if someone's not willing to pay for it. And so, in the craziest example, if you buy a house at a great value, but it's in the middle of the ocean, is anybody going to pay to live in it? They are not. So, you might find a great deal, but you cannot forget that the people who are willing to pay for it is the true asset there. So, when you're looking at location, when you're looking at properties, always keep that asset in mind as well as the tangible asset of the property.
If you could go back in time and give your younger self one piece of advice, what would it be?
It would be to listen to my gut. It would be to know when to exit. It would be to trust myself over everything else and to know the path that I'm on is the right path for myself and to not be influenced to steer away from that.
Do you have a book recommendation?
I really love Principles of the Changing World Order with Ray Dalio. And the reason is because not only has he gone through, he explains market cycles in the book previous to this, but this is sort of where we are as a country and where we are as a world compared to cycles in the past. And so I just think the more you educate yourself on market cycles, the more you are able to foresee what is going on and the easier it is to play the chess game of money. So if you understand market cycles, like I'll run through one really quickly. There are four quadrants in a market cycle. In property values or assets are low and money is inexpensive, meaning interest rates are low. So houses are cheap, money is cheap, rates are low. When a lot of people have access to money because money is cheap and everybody's getting a loan, then everybody goes out and makes offers on these houses. It drives the value of the assets up. So it drives the cost up, right? Inflates it. And so now you're at stage two where you've got an expensive asset. Then when that happens, the feds are like, oh my gosh, inflation, we need to raise the rates. So then the rates shoot up. Well, when the rates shoot up, less people have access to money, less people want to borrow money because of what we've been taught about it, like don't borrow money when rates are high, right? It's ingrained in you. So then when less people have access to it, well, nobody's over offering. So then the market cools and the assets cool back down to their real value. Well, when there's not enough spending in the market, the feds are like, oh my gosh, we need to lower rates to get people to spend money. So then here we are back at the beginning, right? So if you read books like that, you can kind of see when this is happening and then when this happens. So then you know the next thing in the series is for this to happen. So if that happens, but the rates are still high, the smart thing to do would be to get liquid to do cash out refinances, which is what our business is heavy on right now, in order to buy the assets when they are low, when they are cheap. And then when the rates fall, everybody else is coming after them, but you've already bought them.
What single strategy, process, or tool have you implemented that has had the biggest time saving impact to you or your business?
So this is my fifth business. My Barbies had businesses when I was little. I've dabbled in other things, and every single business I've had, the best thing I've done is put in Kanban structures. For example, when I had a cookie company, instead of making the cookies to order and having them be available, we would take all the orders up through midnight. The next morning, the team would make the cookies, get the cookies out to either the local coffee shops and sandwich shops, and then ship the orders that had come in for shipping. Then they would go back and replenish the cookies that needed to be replaced. And then we would wait orders through midnight, next day do the same thing. And so what that prevented is it Kanbaned, okay, the cookies are made between these hours. The deliveries happen and the shipping happens between these hours. The replenishment happens here. And I'm only paying for, I don't know, 6 to 8 hours of work every day instead of paying for someone to stand there for 12 hours a day for maybe one order to come in and then the discombobulation of shipping and all that stuff. So in this regard, the way that the business works is you have to find a property as an investor, and then we have an intake form. So we ask for all of the information on the intake form as a deal summary. So everything is right there. You're not texting me back and forth. You're not piecemealing emails with little bits of information. And oh, we forgot. We have everything we need. So then we take a look and we're like, okay, here is your rate. And then we get the application. And then the processing team orders the documents needed, right? So it's a very structured. It's sort of tech savvy, I guess you could say, but that's why we're able to close in 30 days because it's organized in Kanban like that.
So a cookie business to real estate investing.
Yeah, that was my first.
Yeah, I get that. No, I really appreciate it, Bridget. This has been a great conversation. You could learn more at getbrickcapital.com. Getbrickcapital.com. It's going to be a clickable link in the show notes, but it was great to meet you, and I hope you'll consider coming back again sometime.
Sure. And all of my socials, by the way, are the Bridget Brick. So Facebook, I have a huge community. I think it's like 80,000. So THE Bridget Brick on Facebook, Instagram, Twitter. You'll find me.
I appreciate it.
All right.